Hello and welcome to Investment Insight, your clear take on the markets. Let's get started. So today we are diving deep into two really big market stories. And on the surface, they look, completely disconnected.
They really do.
But they share this fundamental theme. It's this clash between the future we're always talking about, electric cars, AI everywhere, and the current kind of grinding financial reality.
The reality that controls how fast we actually get there.
Exactly. So our mission is to give you the shortcut to understanding that friction. First, we're looking at Honda. Why is a huge automaker like them suddenly tapping the brakes on a full EV push?
And it's not because the tech is failing.
Right. It's about what people can actually afford. Then second, we'll pivot to the cutting edge, the AI supply chain in Asia. We've got this paradox where companies like TSMC are making record profits.
They hold all the cards.
But their stocks are valued much lower than, say, U.S. big tech.
And that slowdown, that valuation discount, that's
Yeah.
exactly where the story is. The goal for you, listening, is to get beyond the simple headline that EVs are the future or AI is taking over.
Because those things are true, but they don't help with timing.
Exactly. They don't tell you when to invest or what to do when the market just hits a wall. You have to understand the constraints. Financial, logistical. The present reality, it has veto power over the future's timeline.
Okay, let's unpack that, starting with segment one. The auto affordability crisis. We saw this pretty surprising announcement from Honda. They're prioritizing gasoline and hybrids for 2026. So if EVs are the future, why are they saying their EV strategy is going to, and this is a quote, take a back seat?
It all boils down to one thing, really, the affordability crisis. It's just simple consumer economics.
What do you mean by that?
Well, recent analysis shows the average new car price in the U.S. is stuck right around $50,000.
$50,000. Wow.
Now, add on top of that the high interest rate environment we've been in. What you get is this brutal 1-2 punch that sends monthly payments through the roof.
So people just can't afford the payments.
They're being strained to the breaking point. A lot of middle and lower income consumers simply can't service that kind of debt.
Okay, but let me push back on that a little. What about all the incentives for EVs? And the long-term savings on gas and maintenance? Doesn't that balance out the high sticker price?
That is the perfect question. And it's where the idea of let's call it a risk premium for the consumer comes in. The long-term math should work.
But it doesn't feel that way to the buyer.
No, because they're focused on the immediate hurdles.
Yeah.
To them, the EV is the car of the future, which is great, but it's also the car I absolutely cannot afford right now.
The monthly payment is what's real.
Exactly. You've got the high initial cost. That's barrier number one. Then you add uncertainty about charging. You add depreciation concerns. And very often, higher insurance rates, too.
So the buyer is being asked to take on all this immediate pain for a benefit that feels theoretical, especially when money is tight.
Precisely. And Honda realized they can't dictate the market's timeline. They have to follow the consumer's wallet. If you want to keep sales numbers up and cash flowing,
You have to sell what people can actually buy today.
you have to. So this isn't abandoning EVs. It's a priority realignment.
A cash flow concession almost. They're making money on gas and hybrids now to fund the EV transition for later.
That's the core of it. The Honda U.S. sales chief signaled a timing adjustment for 2026-2027. They need reliable, high-volume sales. And right now, that's coming from lower-cost gasoline cars and, crucially, their hybrids.
Okay, so what about the regulatory side? Is the government forcing their hand or giving them an out?
It's more an out. The regulatory landscape gave them the breathing room to make this call. The U.S. policy adjusted the required speed of the EV transition after 2025.
So the deadlines got more flexible.
They got more flexible. The standards for internal combustion and hybrid engines were relaxed, giving automakers more runway.
Which means there's less of a penalty for building more gasoline cars right now.
Exactly. If they were facing huge fines for not hitting EV quotas, this would be a much riskier move. But with that flexibility, they can lean on their big strength.
Their hybrid technology.
Right. It's the perfect buffer zone between pure gas and pure EV. They can still lower emissions without breaking the bank on expensive EVs that aren't selling as quickly as they'd hoped.
So the takeaway for an investor isn't EVs versus gas. It's more about who can best manage affordability and policy right now.
It is. It's about adaptation. You're seeing ambitious goals run smack into the reality of high borrowing costs and strained household budgets. It's a global trend.
Okay, let's transition. We're going from consumer demand hitting a wall in the auto market to capital flows hitting a wall in the chip market.
A completely different sector, but a very similar dynamic.
Right. We're looking at the AI supply chain,
Yeah.
specifically key players in Taiwan and Korea. They have the bottleneck. They're making incredible profits.
Hmm.
But the paradox is their stock valuations are, stubbornly low compared to their U.S. peers. How can the companies holding the keys to the kingdom be trading at a discount?
You have to start with the numbers to really get it.
Yeah.
And the best example is Taiwan Semiconductor, TSMC. They make almost all of the most advanced AI chips.
They're essential.
They are. The structure of the AI boom means whoever holds that bottleneck, they capture the margin. Look at their Q4 2025 net income. It surged 35% year over year, a record high.
And what about their pricing power? Are customers pushing back?
Not at all. Their gross profit margin rose to 62.3%.
Mm-hmm.
That tells you they can charge a premium, because if you're an Apple or an NVIDIA, you have to pay what they ask.
They have no choice.
No other choice. And on top of that, their capital expenditure, their CapEx, for 2026 is planned to be between $52 and $56 billion.
So they are betting big that this isn't a temporary boom.
It's a signal that this is a long-term structural cycle.
Okay, so proven profits, monopoly power, betting on the future. And yet, the stock is cheap. When we say cheap, what are we actually looking at?
We're generally looking at the forward price-to-earnings ratio, the PE ratio. Basically, how much are you willing to pay for $1 of future earnings?
And for Asian tech, that number is low.
Very low. For something like the KOSPI index in Korea, you're looking at a forward PE of maybe 10. In the U.S., big tech companies can trade at 20, 30, even 40 times earnings.
So the market is saying, yes, we see your huge profits, but we're only going to pay a small price for them. Why? That's the core question.
It is, and the answer is two parts, and neither of them has to do with the quality of the company itself.
Okay.
Part one is the risk premium. Investors see geopolitical tension and policy instability in that region, and they attach that risk to the stock.
So it's not a TSMC problem, it's a regional problem. They're pricing in the risk of, well, a conflict or some other major disruption.
Exactly. You get fantastic earnings, but you accept a lower valuation multiple because the stock carries a political risk that a U.S. company just doesn't have.
That makes sense.
Yeah.
It's a drag on the price. What's the second factor?
This one is more about market mechanics. It's called crowded positioning.
Crowded positioning.
Yeah. Let me use an analogy. Imagine the world's best band is playing in a concert hall. The show is completely sold out.
Okay.
The band is making record profits from the show, but you can't sell any more tickets. Every single seat is taken. There's no one left to sell to.
The stock is full.
The stock is full, precisely. Data shows TSMC is an historically crowded stock. Something like 92.7% of all active emerging market funds already own it.
Wow. So everyone who could buy it.
Has already bought it.
Yeah.
And they've probably bought as much as their fund rules allow. When a stock gets that crowded, it hits a wall. There are very few new buyers left to push the price higher, no matter how good the next earnings report is.
So the money just stops flowing in because it's already there.
Right. And that forces investors who still want AI exposure to start looking for the secondary beneficiaries.
The companies that haven't hit the wall yet.
Exactly. So capital starts flowing into high bandwidth memory suppliers, advanced packaging companies, power management, the server supply chain, all the essential but less visible players.
This all ties together so well. Let's synthesize this. We looked at Honda slowing down and TSMC's valuation being held down.
Mm-hmm.
The common thread seems crystal clear. In both cases, the current reality, whether it's consumer affordability or investor liquidity, is overpowering the long-term story.
It's trumping the narrative. EVs are the future, but high interest rates are the present. AI chips are essential, but investor crowding is the reality check.
Right, so the question for investors has to shift.
It absolutely has to. It's not just, is this technology the future anymore? The real question is, who is best adapted to survive the constraints of the present?
That's a great way to put it.
Investment decisions have to include these other factors now. Positioning, regional risk, they matter just as much as the earnings report.
Which brings us to a final thought for you to think about. We've just seen how the best, most essential company in a sector, like TSMC, can become so popular that its stock gets stuck. It's limited not by its performance, but by the crowd.
Curse of being too good.
So for your own investments, how do you balance that? How do you weigh the proven safety of a market leader, which might have limited upside, against the potential of a less visible but still essential secondary player in that same supply chain? Where's the real value hiding? Don't forget to subscribe and hit that like button.